Hey traders, this is Blake Morrow with Trader Summit. It's Friday and I have Mr. Jim Welsh of Macro Tides with us. He's here to break down, well, probably everything that's happened this week, but more importantly, going into next week, we're going to have a massive amount of data coming out and a lot of market moves. So let's bring in Jim Welsh. Jim, how are you?
I'm doing great, Blake. Hope you're doing good too.
I am. It's Friday and I'm doing well. It's nice to have you here. And we've had some, well, let me just say this. The S&P hit new highs of the year, I guess.
Not quite.
Or at least tested them today.
I think it got within a point, plus or minus a tiny little bit of the high that was reached in late July at 46.07. I think it got to 46.06. It's almost like, I was going to make a joke, but I won't. They're teasing us.
Yeah, and look, the data that we got today, we got jobs report was strong, unemployment dropped. You got inflation expectations that have come down, yet sentiment improved. It's all Goldilocks stuff. So what do we make of all of this, Jim? I mean, the market likes it. Do you like it?
Well, again, the market's been running on the idea that there's no recession in sight. And so obviously today's employment numbers, weekly hours, hours worked per week increased by, like a tenth. But again, that's a sign of firmness. The job number was healthy. Wages month over month up 0.4. So it's a little sticky. But again, if you want to see the economy continue to be okay, no recession, earnings then are going to be up 11, 12%. This number fed that narrative. And so maybe you were thinking before the jobs report, the Fed's going to cut the funds rate 5 times next year. Maybe they only do it 4. So to your point, it's like Goldilocks on steroids.
Well, at this point, though, you think about where rates pricing is at and that the Fed's going to cut rates, maybe not 5, maybe 4. Is it, in your view, still too aggressive at this point?
Yeah, I think it's way aggressive. It doesn't compute. The Fed has never cut the funds rate when core inflation was above 2.7% and the unemployment rate was below 5. So we're at 3.7 on the unemployment rate, and core inflation, the last read I think was 4%. So, again, I keep talking about, yes, inflation coming down is a big deal. Wall Street believes that just because inflation has come down, the Fed is automatically going to cut the funds rate. And to me, that overlooks the idea of, well, how much tightness is there in the economy and still in the labor market? And, again, unemployment rate at 3.7, that's just barely off a 50-year low. Capacity utilization is north of 78%. So from the Fed's perspective, Blake, it isn't, well, let's just look at 2024. I think their notion is, yes, we want inflation to come down next year to near our targets. And then what's going to happen in 2025 and 26? Because if we start cutting rates and all of a sudden the economy improves in 25 and 26, and these other measures of tightness aren't really relieved enough, you're going to see inflation pressures build up quickly in the next business expansion. And the Fed has said, we want to avoid the mistakes in the 1970s. So that would, I think, risk repeating one of those mistakes. So again, I think the Fed will be content to just keep the funds rate there for an extended period of time as they see how this all plays out. Now, some Fed governors have talked about it, and I think there'll be more, in the idea that, okay, if inflation comes down and we hold the funds rate where it's at between 5.25 and 5.5, the real funds rate will start to increase. Well, that represents a modest tightening of monetary policy. However, and we've talked about this, we've seen a tremendous drop in financial conditions. In other words, they've eased very significantly. So in my mind, that kind of offsets, the modest tightening that might happen. Now, financial conditions jump all over the place because they're based on market activity. Stock market goes up, bond yields come down, financial conditions ease, and the opposite's true when stocks go down and yields go up. So my point is that yes, they can talk about potentially cutting the funds rate because the real funds rate is climbing, predicated on inflation continuing to fall. I just don't think that that just completely ignores the idea of what's happening with financial conditions. As you might remember in November, the November meeting, it was like, wait, the increase in financial conditions represents 1 or 2 rate hikes. Well, they've been pretty much taken away. So, this is a moving target. I just think Wall Street has adopted a point of view that the Fed's going to cut rates, even though capacity utilization is high, unemployment is really, really low, just because inflation's come down. I just don't think the Fed's going to move in that direction as aggressively as Wall Street is pricing in.
Well, Jim, I know your first chart. We might as well just bring it up right now.
Yeah.
And you've obviously discussed a lot of these topics before with us, but first one is five rate cuts in 2024. So has that changed after today?
Well, it might change modestly, but more importantly, the reason why I'm showing this in the next chart again, because we did look at these last week, is we got the Fed meeting next week. Chair Powell's going to have a press conference. And the employment report, that's great. The economy's still showing pretty good signs. Well, to me, that gives Powell fodder to be able to, and it's reasonable for him to push back against the idea of Wall Street thinking that we're going to be cutting rates aggressively. I mean, if he had a soft employment number, in other words, sub 100,000, that's a whole different world. But we didn't get that. So to me, I think Wall Street's not, if I'm right and they're way ahead of the Fed and Powell notes, hey, we're really happy to see inflation come down. At the same time, I think it was about 2 weeks ago, he said it would be premature to price in rate cuts at this point in time. And we're prepared to raise, funds rate if. So I just think Wall Street hasn't listened to that message, doesn't want to. I just think that the jobs report and the framework that Powell has been operating under is probably going to lead him to push back maybe a little bit more aggressively than he did when he gave a speech. I think it was last Friday. We talked about it at Spelman College.
Yep.
So anyway, so the next chart is the financial conditions. They've eased, this chart is about a week old. So they've eased even more than this chart is representing because treasury yields are lower. Stock prices are a little bit higher. So again, I just think the Fed pays attention to financial conditions. They know that the level of financial conditions exerts pressure on the economy. And in this case, we've seen mortgage rates go from about 8% to the low 7s. Well, that's going to be somewhat beneficial for the housing market. So anyway, I just think I'll be surprised if Powell doesn't push back against what Wall Street has, adopted as far as, the Fed's, because inflation is down, they're going to be able to cut rates.
Right. But okay, so next week I don't see any charts regarding inflation, but we do have CPI the day before the Fed.
Yeah.
So what are your expectations there?
Well, we've seen obviously a big drop in oil prices, gasoline prices, used car prices down some more. So the headline number is going to be, I think, pretty soft. The core number might be a little bit more sticky. So again, I think that dichotomy between the headline and the core is going to continue for a while. The Fed pays far more attention to core CPI and even more attention to the core PCE. So again, I think that number is going to be, Wall Street's going to be happy with that. Now, my guess is, if I'm right, you're going to see both numbers come down a little bit, headline more, people pay more attention to that. And one of the reasons we've seen the University of Michigan, and you referenced this, the inflation expectations drop pretty significantly. Well, that's because for the last month, people go to fill up the car tank and whoa, it's down another 5 to 8 cents. Oh, it's down another dime,
Look, and I was trying to explain to people, the American consumer is pretty, as far as inflation goes, fairly uneducated. So they're going to report what they feel. Yeah. So if prices at the pump have gone down, automatically, I'm fine. It's okay.
Yeah.
Things are getting better.
Last time I filled up my tank, it was $65, and this time it was only 57. Woohoo!
Yeah. It's amazing, but you also have to imagine that is the general public. So
yeah. Personally, I don't put much stock in those inflation expectations. The Fed does, because they want to make sure that they're anchored. And to me, there's so much variability. And as you point out, consumers kind of are just reacting to whatever's happening right now. I don't think they're thinking about inflation 3 to 5 years from now. They're just trying to make the ends meet right today.
Right. Well, let's talk about the first market that you brought, the first major market here, about the dollar, because the dollar's, over the last week and a half, we've kind of recovered, and that sell-off that you see right here, that one was mostly the dollar yen. The rest of the dollar pairs were just kind of staying steady. But longer term, what is this telling you?
Well, again, I've noted 1, 2, 3, 4, 5. So, the expectation was that if we saw a decline below 10, whatever it was over on the left-hand side, I can't see it because I'm not putting my glasses on. The point being is, last week it was like, okay, I think we're going to see a rally up to the 104.90, 105.48. That first pop was about 180 basis points. Then you had the yen pullback, 103.20 or so. Well, you add 180 to 103.20, what do you get? You're right in the zip code of 105. So if I'm right and Powell pushes back against rate cut, craziness, I'm assuming that's going to be somewhat supportive of the dollar, and we'll see the dollar bounce a bit more, as a result of that. So, to me, my take is, and has been, next year we're going to see, I think, a fairly significant decline in the dollar index below 100. But first we were going to see a rebound. And now we're just waiting to see how this rebound unfolds and try to identify when it's running out of gas. And it could be a little funky sometimes with currencies.
And so we could see 105, 106. You're really just not too sure at this point.
Yeah, it just comes down to, like I said, 105.48 is the 618 retracement of that whole decline from the 107.34 high to the low we saw, a week and a half ago.
Okay, well, here's the market. Everybody wants to know what happened here with gold. That was a hell of a gap up on Sunday. It got sold aggressively. Looks like we're trying to break down today. What do you make of this? And is it scary? If you're long, should you be concerned? It looks like we broke a little support here. What are you thinking?
Well, to me, that reversal Sunday night and Monday, caused me to say, wait a second, maybe I need to reevaluate the price pattern. Okay. For a couple of reasons. That key reversal was fairly dynamic.
Yeah.
I think the spike might have been in part because there was some attack on U.S. ships and some other ships. So you might have gotten a little goose there. The other thing is the rally from 1812 to 2008, $196. You add it to 1933, and 2 legs equal would have been like 21.29, and it got to 21.22. So it's like, whoa, could that have been an ABC up?
Yeah, that's the way I looked at it. This is a ABC, D. Well, I call it equal leg move, but those two are exactly equal.
So what that all of a sudden suggests that there's a probability, whether it's 10% or 50% remains to be seen, is that the decline from the high in early May, what was that, 2057, 2059, down to 1812. Right now I have ABC down. That's all of wave 2. Well, it's possible that was wave A of 2. This spike up as an ABC is an irregular B of 2, and gold's going to drop below 1812. Okay. So it doesn't, in my view, change the much bigger picture. I think gold's going to 2,300 next year, but it implies that you could have a pretty sharp decline here, obviously. And what would cause that? Well, what if the dollar strengthens more than what I think it will? You know, I'm looking for a bounce. I'm not looking anymore for it to get above 107.34. I might be wrong. So for me, Blake, I basically said it's on gold. You know, you might want to put a stop at around 2005. That's the 618 retracement of the most recent rally from 1933 to 2122. And the reason why is the assumption I'd had prior to that reversal is that we had wave 1 up, wave 2. We were in the early stages of wave 3. And you could say, okay, that's wave 1 of 3, 1 of 3 of 3. You know, I mean, you get a little goofy with the numbers. And this is a wave 2 pullback. And then you're going into the third wave of the third wave. All right. A blast off.
Right.
Well, if that's about to happen, I just can't see gold retracing much more than a 618 prior to that blast off. So my take was put a stop in on half the position, because I've been recommending gold at 2005, and another stop at about 1773. That's the 786 retracement, which seems like, again, it doesn't jive with the idea of going to, you know, we're about to really blast off with gold. So that reversal, the equality of the two legs, you know, it's like, okay, you know, in a sense, we're detectives. And, you know, you watch crime things on TV and new information comes to light. And all of a sudden, hey, we might have a different suspect than we thought. And well, this Jim, is, to me, a case in point with gold.
Well, you're giving away everything from your newsletter. So before we get into the last couple of charts, why don't you tell people how they can get a hold of your newsletter?
Okay. Well, you can get information about how I do all this happy stuff, macrotides.com. If you send me an email to Jim Welsh, WELSH, macro at Gmail, I'll send you, you know, a recent weekly technical review, because I do kind of go into this kind of detail. And on Monday, after that reversal, this was the main topic regarding gold.
All right, good. I wanted to make sure that you got that in, because you're just telling everybody what the master plan is. And I want to make sure
reality is it's like a two-armed economist. Well, on the one hand, it could be we're going to the moon, and the other hand is, holy Moses, we're going below 1812. Talk about in-depth analysis. There's time, you know, what I try to do is be honest with myself and everyone else in terms of I really don't have a high conviction level in terms of, but we just got
okay.
Well, it is. I mean, I think people feel like, man, I better have an opinion or a view all the time. I've found that sometimes gets you into big time trouble. And we're at a point in time with a number of these markets where, to me, prices need to provide more information before I will have a higher conviction about what I think is going to happen. Okay, so in late October, I recommended buying TLT. I thought Treasury yields were going to be coming down. As we all know, back then, you know, 10-year got to about 5%. Everybody was like, oh my God, the sky's falling. They're going to 5.5%, 6%, and so forth. You had 5 down from March of 2020 on TLT. And so this is why the intersection of technical analysis and fundamental analysis is crucial, because all those people talking about 5.5 and 6, they weren't paying any attention to the longer term chart pattern of TLT. At the same time, we're going to see the economy slow. It's just a question of, does it slow enough to go into recession, or just slow enough to scare people that a recession might occur? So we got a nice bounce off TLT. I was probably overly aggressive when I sold the second half. I said, I might be trying to be too cute here. But what we've seen, Blake, is, you know, I think obviously an impulsive move higher, which to me, I'm going to interpret as, after any pullback, we're going to see another drive higher. So as I've said, this is going back since late October. I think a rally to 105, 109 is coming next year. Why? Because those are retracement levels of the decline from 179 down to 82 and change. So anyway, the strength that we've seen, to me, implies that, yes, I think we're nearing a pullback. If I'm right about Powell pushing back on rate cuts and everything else, that'll be an excuse for some people to take some money off the table.
Yep.
But to me, this, whatever pullback shows up, it's going to be a buying opportunity, because I think we're going to see a subsequent rally that takes TLT up. And the magnitude of this first rally, it's almost $14. So if we do a $6 pullback to 90, call it, and then you get an equality move of another $14, voila, you're just about at 105.
When else, Jim, have you seen the bond market move like a crypto?
Well, you had a lot of shorts, obviously.
Yeah.
I think the rally in November was one of the biggest rallies in decades in Treasury bonds in terms of how much yields declined. Again, that's why I think one has to incorporate technical analysis with fundamental. I think those who trade currencies on balance are almost exclusively focused on technicals. And that's why hopefully our conversations every week is not nudging some people to kind of like, well, maybe I better pay more attention to what actually is going on. And it's hard because most of the stuff you read, most of the stuff you might hear on CNBC and Bloomberg is virtually worthless. It's and I can only say that because for a long time I used to think that there were people that were a lot smarter than me, and then over time you realize they don't know anything more than me. And it's like, wow, could that possibly be true? Anyway. I digress.
All right. Well, Jim, tell us where in your average intelligence, tell us where.
Thank you for that left-handed compliment.
Tell us where the S&P is going, because here we are, challenging these highs as we pointed out.
Yep. Well, again, let's go back. To me, 5 waves down into that low in October, the expectation was that we were going to see Treasury yields decline by a fair amount, which would be very supportive of the big mega cap stocks because they feed off of what's happening with Treasury yields. I thought we could get to 4,500. We got there way faster than I would have expected. And now it's a question of, all right, are we just going to keep blowing to the upside, or are we going to have a pullback?
So
we're going to have a pullback.
I'm sorry, I hate to interrupt here, but you used the terminology with the bond market as impulsive. Would this be impulsive? I mean, that's a hell of a rally in the last.
It's a heck of a rally.
Yeah.
But if you look at the way the TLT rally broke down, this looks like A, B, and we're doing this what I think is a C wave. Now, if we get a pullback and then back, let's say to 44.85, and then another push to 46.33 or maybe a touch more, then you could count 1, 2, 3, 4, 5 up. I can't count 5 up here. It's just not there in a clear way. So to me, what this implies is we're overbought. The market has rallied on the idea that the Fed's going to be cutting rates, economy is going to keep going up. I think we're ripe for a pullback. There's a gap at 44.21. I think there's a high likelihood the S&P will pull back to 44.21. What I don't know yet is, are we going to see some additional strength that gets the S&P up towards that 46.33, which is where A and C would be equal? Before we get the pullback, or are we going to get the pullback first? I don't know. All right. I believe the probabilities have increased based on the strength we've seen that we get this pullback. And if that pullback is 3 waves, down, up, down to 4,400, call it. The S&P is going to have another push higher into early next year that will probably approach 4,800, and it could take it out by a small amount. All right. I mean, if we think about it, from 4,100 to 4,600 is 500 points. If the S&P pulls back to 4,400 in 3 waves, well, what's 500 on top of 4,400? 4,900, So the only thing that would be a fly in the ointment is if we see a clear 5-wave decline as the S&P, if it does, pull back towards 4,400, that would change the picture, for me. But my assumption here is Wall Street is bulled up. They're going to stay bulled up because just because Powell pushes back doesn't change the overall narrative. The economy's not going into recession. Earnings are going up. Okay, maybe the Fed only cuts 4 times, maybe only 3. But the core foundation of the bullish argument is no recession, earnings going up. And as long as that remains intact, and I don't see how that's going to get toppled between now and, let's say, the end of January, I just think that, buying a dip will be the execution here. So now, for me, it's just a question of, all right, let's see what kind of pullback materializes. Does it close that gap? Is it 3 waves? If all those pieces are in place, then I'm going to be saying time to go long because we got to move back up. That'll take out 46.07 if it doesn't do it in the next handful of days, and approach 4,800 and maybe go a bit higher than that. So sometimes you have to listen to what the narrative that Wall Street has developed. What's going to change it? And I don't see it. Again, I don't think it's realistic. I don't think it's likely to unfold. In fact, as you know, my take is we're going to see a fairly significant slowing in the first half of next year. So the idea that, we don't have to worry about a recession, I think there'll be some concerns reappearing, and the Fed's not cutting 5 times if you don't have a big time slowing in the economy. So,
Jim, I hear what you're saying, and I have to say a great example of where the market can dislocate from an economy. You take the German DAX at all-time highs, and if you look at the German economy, it's falling apart at the seams from a manufacturing point of view. So,
and they depend on manufacturing. I think it's about 30% of GDP is manufacturing. In the US, it's 12%. So you're right. They're in recession. But I think part of that is just driven on the idea that, the ECB is going to be cutting rates, blah, blah, blah,
Hey,
anyway.
Well, that could be the same story for the U.S. markets. And so it's important to keep an open mind, right?
Yep, absolutely. When new information comes in, marrying a narrative can be fatal. And I think Wall Street shows that repeatedly over the last 18 months. Remember all the times they were looking for a pivot last year? I mean, it was like we're in a revolving door. Fed's going to pivot. It was stupid, but they can stay stupid until they're hit over the head by a 2x4. And so to me, I think in the first half of next year, we're going to see them realize the Fed's not cutting as aggressively. And I think as we get further into 2024, the idea that we don't have to worry about a recession is going to be challenged.
All right, Jim. Well, I tell you, good luck next week. It's going to be a busy one. And I'm just kind of doing it without looking at a calendar. I'm almost thinking that next Friday might be one of our last meetings of the year. I don't know. We haven't sat down and looked that far in advance, but I'll tell you what, I appreciate our meetings here every week. I hope you guys and gals at home do. Make sure you give Jim a big thumbs up, subscribe to the channel down below, hit the bell icon. So this way you're alerted every time Trader Summit has a new interview. You can do that via YouTube, and then you'll see a push notification on your mobile device. And jump down below in the comments and tell Jim how much you do appreciate his analysis.
Yeah, you can tell me things like, "Hey, Jim, you're getting close to needing a haircut." Well, okay.
Jim, I was going to mention that, but you did.
Yeah, well, thank you for, I'm amazed whenever I get a haircut and I look down on the floor. It's like, wow. There's a lot of gray hair down there.
Well, Jim, have a wonderful weekend, and thank you for your time here. I know we all appreciate you, and so we will see you next Friday.
You got it, Blake. Take care.
Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.